Okay, what is up, boys? So this is going to be the fair value gap video for the people that came to the YouTube videos on the boot camp. If you're from the Discord, congratulations, you're taking the first step. This is kind of the first real trading thing, I guess you could say. We had break of structure so far. We've had trends. We've had candlesticks. And now we've had liquidity sweep, and now we're on to the fair value gap. And fair value gap is kind of like one of the things I still use to this day, which I think is honestly one of the most important things in trading too. I think all of these things hold a very good amount of significance, but it's a very, very important thing. So what a fair value gap is it's basically an imbalance from the buyers to the sellers or the sellers to the buyers. That's basically all it is. People are going to tell you different things. That's all a fair value gap is. And how you determine, like when you see an imbalance, is this gap right here. So do you see how this candle, the previous candle comes up, opens, closes, wicks. This candle opens right here, closes, wicks. And there's this huge gap right here. There's nothing there. The wicks don't overlap, nothing. And there's just a blank candle space. That's called a fair value gap, okay? FVG. And you draw a box on it. I'll write that out for you guys. It's FVG, fair value gap. Okay. So what it is, if you ever see it in a Discord, FVG means fair value gap, or they just put fair value gap. There's also something called an IFVG, which, damn, what the fuck's my keyboard tweaking? Which is this then an inverse fair value gap. FVG goes to fair value gap. IFVG is inverse fair value gap. And I'll explain each of them in this video. But fair value gap is basically the main one you guys want to use unless you're using a different model than what I use. But if you're here, you're most likely going to be using my model. So what a fair value gap is it's the imbalance. And the wicks cannot be touching. So I'll draw it out. Wick right here. The wick right here. You see how these wicks overlap each other? So this wick overlaps with this wick. They connect right in this area. Okay. Yeah, it looks like a dick, but see how they overlap with each other? It's not a fair value gap. This is a fair value gap, and this is a 4-hour fair value gap. This is a fair value gap that holds a lot of power in the market. Okay. As you can see, we create it off this candle. We tap it, and then we dump 70 points. We don't tap it again. We tap it this time, and we continue to dump for what it looks like from the 18th all the way to the 20th. So basically for 2 days, we decide to dump just off of that fair value gap, okay? That's absolutely ridiculous. That's a huge, 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 huge move. That is a 810 point move just off of a single fair value gap. But it's a 4-hour. 4-hour holds a lot more power than the 1 minute is going to hold. We'll go over time frames later, but 4-hour, daily, weekly, monthly, they hold a lot of power compared to the 1 minute, 5 minute, and like 15 minute. But as you can see here, we also have another fair value gap right here. Okay, it's already previously been tapped into, but it's being respected with these. And then right here, we have a liquidity sweep or a turtle soup. Right there. Let me see. I like you. Liquidity sweep. And then you're probably wondering, what is this middle line of the fair value gap? This is called the CE, the constant encroachment of it. And it's where price usually likes to react off of these like levels. This is where I want to see. So if I'm going to take a trade, I want to see basically price come down like this. I want to see the wick go straight down, basically tap it, and go into very, very low amounts past this point. As you can see, none of these did that. So I personally would not have taken any of these fair value gaps, but that's just what I like to see. So it looks something like this. You have your candle, wicks down below it. You're going to have your box. This is your candle, and then your other wick like that. I want to see something look like that, and then I want to see the next candle look something like this. Showing that we have a bullish bias out of the fair value gap. Okay, that's 2 examples of a fair value gap. Let me find another one real quick. They're everywhere. They're definitely harder to spot on the 4-hour because the 4-hour is huge, but right here. Bullish fair value gap. As you can see, there's a huge just blank space in this candle. It's a bullish fair value gap, basically meaning that if we tap it, we want to move upward. And that's exactly what we do. We tap it, and then we just want to continue all the way upward. Super simple. I'm going to drop us down to the 15 minutes. So you guys see what a 15-minute fair value gap looks like. It looks the exact same, but price is going to remove it a little differently off of it. Let's see. Do we tap this? Yeah, right here. Okay, as you can see, 15-minute bearish fair value gap basically means bearish means it wants to go down. Bullish means it wants to go up. As you can see, we tap it right here into this. Once the box starts, tap it. We go down. We retest it. Basically, I believe we sweep these highs, actually. Yep, sweep these highs. We have a liquidity sweep. So this way, I mean, when you start pairing them together, fair value gap with a liquidity sweep. Oh, what do we have right here too? Break of structure. And then on top of that, we have another fair value gap. This would be your entry. If you actually took this trade, this is a beautiful, beautiful trade. You just have your stop loss above the fair value gap, and then you're targeting whatever points you want to target. You can target this low all the way down here. Bam. I just showed you guys how to make a 1 to 17 RR with 3 confluence. Break of structure, fair value gap, and oh fuck, lost my train of thought. Break of structure, fair value gap, and liquidity sweep. But yeah, it's super simple. The fair value gap is absolutely an amazing, essential part of trading. I'll show you guys one more bullish and one more bearish fair value gap. Let's see. Right here. Bullish fair value gap. So basically means we tap it, come down into it, and we want to go higher up off of it. So this candle did not close. This candle body does not close down here. It basically means we're respecting the fair value gap. If we were to see something like this, I'll show you a fair value gap that is not a good fair value gap. Right here. You saw this candle of this body closes below the fair value gap. Basically means it got inverse. That's an IFVG and inverse fair value gap. Basically means we don't want that. If our bias is to go upward and it inverses it to the downside, that's not good. Our trade is invalid now. We are not taking that trade anymore. Okay. Same thing with a bearish one. Let me see if I can find a bearish example of one. Right here. Let's say we wanted shorts. We want to go down. Okay. We want to see us tap it, and then we want the next candle to then continue down this way. We want it to look something like this. Like that. But we get the exact opposite. Okay. We get a absolute monster of a candle to the upside, and this then inverses this gap because it closes all the way up here. The body closes, not the wick. The wick does not matter. The wick could go 100 points below it, but as long as the body closes above it or inside of it, that's all that matters. If it closes above it or below it, it's invalid. If it closes inside of it like this, you're chilling. That fair value gap is valid, but this is an invalid IFVG or invalid fair value gap, and it is an IFVG. With my strategy, I don't personally trade IFVGs, but a lot of people do. Right here, this is a respection of this huge fair value gap. This bearish one, we tap it, and then we just dump off of it. Right here, 40 points. It's a good solid trade right there. It's like a 1 to 4 RR for me. And that's basically what a fair value gap is. I'll go over IFVGs later. I don't think you guys are ready really for IFVGs yet. I want you to just focus on one of them, but I want you guys to find 3 IFVGs on the 1 minute, or 3 fair value gaps on the 1 minute, 3 on the 5 minute, and then 3 on the 4 hour. And then I want you to find the opposite. So basically, if you were looking for bullish fair value gaps, now I want you to find bearish, 3 on the 1 minute, 3 on the 5, and then 3 on the 4 hour daily, whatever high time frame you want. That's kind of my homework I give for you guys. And then, find a couple, understand what candlesticks are still. Maybe try to pair the fair value gap with a liquidity sweep and a break of structure a couple times. And you can start understanding how the markets actually move, because the markets are very algorithmic and they move the same way roughly. So you guys can start figuring out the patterns. That's all it is. It moves in patterns. You guys can start figuring out. It'll be way, 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 way easier for you guys in the future. But I'll see you guys in the next video.